We're going to get rolling here this week, the one thing that we're probably going to be saying over and over the next few weeks is volatility is gonna be here, and today's trade is no different. Last week, it's gonna be here, and things are going to be swinging in this market. And I think the one thing what we want to do right now is we just kind of always want to bring out here this week. These are some things that we think are important on what's going on. So we're rallying today on weather. What's the weather story? We mentioned a couple weeks ago on how what we really try to look at is early in the week and end of the week, we always put a big focus on the previous 7-day PRECIP map. And I have this up in here right now. And the one thing that sticks out to me is that when you look at the Corn Belt as a whole, 80 to 90% of the Corn Belt got anywhere between a ½ inch and 2 inches of rain. So we really don't have a drought to trade on. We're the leader today in the market as everyone's focusing on North Dakota. And as you can see, the northern half of North Dakota, they're already in a severe drought, and they had very little precip the past 7 days. Now, as we look at a 7-day forecast on the map, you can see where the markets may be getting a little bit excited as there's really dry weather, especially through the northern and northwest Corn Belt. Okay, and then again, that area of focus becomes the northern prairies in here right now. There's some rain or scattered showers forecasted, but it's a relatively small amount, and they have been in a drought. So what occurs? We add some weather premium, and today, Minneapolis wheat is the upside leader. So I think if you want to be bullish these markets based off of weather, and whether if you raise, corn or beans in Missouri, okay, or farm in Ohio, I think everyone right now needs to keep an eye on Minneapolis wheat to see if we break out. And I think there's a couple key points here to look at on Minneapolis wheat. One is when we go back to 2017, the last year there was a regional drought in the northern plains. We had Minneapolis wheat futures run to $8 a bushel. Here about 2 weeks ago, September Minneapolis wheat peaked out just above $8. What we'd want to point out, though, is in 2017, from the beginning of the weather rally to the end of the weather rally, the spring wheat market rallied around $2.50. Okay, so now if we project $2.50 from where we're sitting at right now, that gets us up close to $10. And if you go back to 2012, front month Minneapolis wheat in the heart of the drought rally peaked out around 10 and a quarter. Okay, Minneapolis wheat is the one to watch. Watch the crop ratings in here right now. That is what we believe is a true weather market. If it can get above 8 and a quarter on Minneapolis wheat, there's going to be a lot of talk about spring wheat futures heading to $10. Now, the other thing we look at on the Minneapolis wheat side is how does it compare to other wheat? This is a spread that really has our attention on buying Minneapolis wheat and selling Chicago wheat as a spread. That current spread difference is around 80 cents a bushel. If you go back to 2017, though, that spread went to a $2.60 premium. Okay, if this wheat market and we really rally on weather, this spread should continue to appreciate. It wouldn't surprise us if this spread went up to the $1.50 to $2 range, especially given the crop conditions in spring wheat country. And the other thing, and we'll talk about this more as the month of June rolls along, but as we get to that acreage report at the end of the month, spring wheat acres are probably coming down in favor of soybeans. Okay, corn, soybean acres are going to increase at the end of the month. The spring wheat is going to be breaking back a little bit. Now I just want to switch gears over to the corn market. We've had a lot of volatility over the last week. We have these two horizontal red lines on the chart, the one's at $5, the other's at $5.80. As we just move ahead in here through the early summer, we just don't think you want to get too bearish below $5. On the other hand, we probably need a major weather issue to get a sustained move above $5.80. We think this is going to be the trading range that can really define corn here over the next few weeks. It's just that we visited the lower end of the range and the higher end of the range in the last 4 sessions. When I get over to the bean side of it, maybe on the chart it looks a little bit higher on soybeans and on corn. We don't think we really go below $13 until we get a little further into the growing season. On the other hand, to get a breakout above $14.50, okay, it's probably going to need a major weather event in the Corn Belt. Our range on beans is probably a little higher, like we said, and the reason why is as we look towards that June acreage report, we're much more confident that corn acres can jump up 3 to 4 million acres, and that beans are going to lag behind with only a 1 to 2 million acre increase. That'll be a much more limiting factor on corn compared to that of soybeans. We had these charts out about 2 or 3 weeks ago, and this is a 15-year seasonal chart on corn, and we highlighted this as why we would look at getting some corn priced out. And as you can see, a secondary top on this corn market really occurs in mid-June. From there, if we don't have a weather issue, we are going to be trending lower. This is why we like getting coverage in place in here and encourage price protection on rallies in this time frame. Our bias is this corn market is off to, the corn crop is off to a decent start. And without a drought or a lot of weather risk heading into pollination, we could easily put our secondary high in here in the mid-June time frame. When I get over to the bean side of it, you can see where the seasonals occur a little bit later in the year. Well, we probably have as much concern on beans as we do on corn, and why we encourage price protection in place is just purely the value that we're sitting at right now and how much our demand has slowed down with the bigger bean crop in South America, the fact that U.S. beans are not competitive on the world market, and each month the crush is a little lower than what people would have expected. Those aren't all big bearish factors and going to drive us lower, as we do need a big crop here in the U.S., but it's a reason where we think maybe a seasonal high has already been in place and could be sideways. You probably have some time to get the last of the bean puts in place, but again, on big up days in the market, we think that's something to be considering. Now, as we go in here and want to wrap it up here this week, and again, we try to keep these things short, sweet, and to the point. I mean, our goal on corn and beans, when you look at these values, is to get our crop covered, whether if it's the 80% or 75% that we insure, or go all the way up to 100% of our expected production. And think it needs to be done in a balanced way. If you want to go cash a little heavier, get 40 to 50% cash, balance with options. When we have such a strong market, we think we want to go the option route on half of our crop. Okay, and the reason we believe that is that if we do have some crop issues out there in a smaller crop, we think it's much more advantageous for you to own the physical grain and have the price protection in place with puts than have all the cash committed and buying calls, okay, in case this market heads higher. If there's a short crop, we could get more basis improvement. I think the other thing when it comes down to weather is you got to look at this Minneapolis wheat market, okay? It's the one to watch. Gained over 40 cents in here at one point overnight, up over 40 as we stepped in here today. And watch the previous highs on Minneapolis wheat at $8, okay? That's the market with weather that needs to, that everyone needs to pay attention to, even if you're a corn soybean farmer. This volatility is going to be here to stay. I mean, no doubt about it. We could start off every week saying expect this market to be volatile, and then it comes down to on corn and beans is what would we recommend for some price protection in place. I mean, just today with a big spike up in the market, you could put a Dees corn fence on. You could buy a $5 put, sell a $7.50 call for a nickel. Now we know that's a wide range, but if you take a big picture look at this, okay, if corn's at $4 this fall, you're going to get $5. If corn's at $8, you're stuck with $7.50. I think corn options are really expensive. We'd rather have a fence in corn, okay, than budgeting straight dollars for puts. As I get to beans, though, I think the volatility in beans can be kind of stupid. That's my personal opinion. I think it's best off on soybeans. Just budget dollars for a straight put. Those $13 puts, okay, over the last month have really traded in a 30 to 45 cent trading range. Pick them up on big up days in the market. I think that's a solid game plan. Any questions, feel free to give us a call. Have a great day.